July's producer price index, those are the prices received by domestic producers for their output, rose 0.3% in July. That's higher than expected. It also goes against the narrative to some extent that price pressures are easing. The core PPI figure, which excludes food and energy, also was up 0.3%. It comes after yesterday's inflation report that showed price pressures continuing to moderate on the consumer. But is it still too soon to declare victory? That's been the line from the San Francisco Fed's Mary Daly. In recent weeks, we spoke with her exclusively yesterday after that CPI report.
It is not a data point that says victory is ours. There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target. We don't control gas or energy prices or food prices, but definitely by bringing demand of the economy back in line with supply, we're going to get broader inflation relief. And that's going to be the thing that, I hear it mostly. I have 9 states in the Western United States. I can talk to any single person. I ask them, what's your number one concern about the economy? They still say inflation. More work to do.
So what is the bond market telling us about expectations on the part of market participants? There's been an expectations we were approaching peak yields, perhaps, with data supporting the idea the Fed is near the end of its hiking cycle. Joining us now, Erik Nelson, Wells Fargo Securities macro strategist. Erik, it's good to see you here. I first want to talk about PPI just briefly here because we did see it a little hotter. I know people usually pay more attention to CPI. What struck me, though, was not just the hot July figure, but the fact that the core June figure was revised to a drop of 0.1%. What do you make overall of this report?
Yeah, well, I think you have to sort of respect the different nature of this data. It's a little bit quirky. There's some stuff goes on with some of the margins and how they're measured. So it's a little tough to pull out and directly translate those data to the CPI data. And that may have been part of why you saw some of the downward revisions. But I think if you take a step back here and look at the overall trend in core inflation, whether you look at PPI, CPI, it's clearly lower. Question for me is it enough for the Fed to really take their foot completely off of the hiking pedal and even shift to the cutting pedal? I don't think we're there yet. Because really, in order for them to justify really cuts especially, you need to see a sustained return to 2% inflation. It's hard to get with where the economy's at right now. I think the reality is they need to see something softer on the labor market side, and they really haven't seen that yet to justify cutting. And I'm not sure we're going to get that for I'd say at least 6 months, maybe even longer.
Do you believe that the Fed would be cutting, or not cutting, but raising all the way until that 2% target? Or do you believe that there would be some additional policy implemented and then just kind of a wait and see if we get to some of those metrics? And perhaps on the other side, the risk if we see the opposite and inflation takes another spike higher.
Yeah, I think the Fed is hesitant at this point to just hike because they're not at 2%. They're definitely thinking about sort of the framework of real policy rates, right? Where is headline policy rate versus core or any sort of inflation measure? And that's obviously high versus what they think our star is. They're not really sure. So I think the bias for them is to kind of stay around these levels, maybe hike 1, maybe 2 more times, but they want to be very careful in calibrating that. The question, though, is what's the market pricing? And they're pricing in 6, 7, 25 basis point hikes through the end of next year. And the risk here is that those cuts aren't realized, right? Not so much that you see a significant reacceleration in the hiking. We think about the implications for broader markets.
Well, and what you've said in your recent note I thought was really interesting here is that right around when the Fed's last hike comes, that's when we start to see bond yields start to meaningfully decline. I guess the game here is trying to figure out when that last hike is, if it was at the last meeting or if it's going to be at the next meeting. But it is interesting, that historical marker here. So what do you think? Was it the last meeting? Is it the next meeting? When is that going to happen?
Well, official call from our economics team is that no more hikes from the Fed. I tend to think that there's risks for one more, and that maybe it doesn't come in September, but perhaps later in the year, maybe the November meeting. So that's why we're hesitant to call the top in bond yields. And if you actually look at the price action, yesterday is a great thing to kind of suss out where positioning is and how investors are thinking about the market right now. You saw a pretty soft inflation reading. You've seen generally dovish to balanced Fed speak. And the 10-year yield had a very hard time breaking below 4 yesterday and actually ended up quite a bit higher after some poor auction results. So that tells me that there's not a lot of comfort with peak yields here and that there's still some hesitancy around really piling into the long duration trade.
Well, Erik, what would change that? Is it just a matter of having to get past the next Fed meeting?
I think you have to see some sort of real weakness in the U.S. growth story. I personally thought that we'd be in recession by now in the United States. Obviously hasn't happened.
I mean, you and everybody else saw it pretty much.
Yeah. Yeah. Look, jobless claims are trending back down again. So I think you need to see something shift there. Labor market would be a big thing to watch, jobless claims, but also your monthly jobs reports. Could also be something financial, financial stability related, whether it's, the regional banking issues crop up again. Maybe it's commercial real estate, whatever it may be. Something we're not seeing at this moment is certainly possible. But it has to be something significant on the growth side or the financial stability side. And right now that has not really come to fruition. So for now, we're thinking yields are not done rising.
Hey, Erik, just additionally on, the Fed's calculus here, when we think about some of the stickier areas of inflation, it's shelter, and shelter costs continued to show up. Home costs continued to show up even in the CPI report that came out this week. All that considered, should consumers expect that to abate or recede anytime soon?
Well, it's a great question because this was a huge theme last year, and I'm glad you brought it up because there's this narrative now that home prices and rents are reaccelerating, but to me they're more stabilizing than they are reaccelerating. If I look at the month-on-month changes in some of the private sector measures of rent growth, they've obviously picked up, but they're really just back to pre-COVID averages. So it's probably an overall good thing that we're not seeing outright deflation in rent. That would be maybe more worrying than anything else. You are seeing some more normalization. So that's it. I think that's something that I think the Fed and I think general U.S. consumers should be welcome to see. What you don't want to see have happen is a bigger reacceleration to something we saw in 2021 or 2022. That's obviously going to be a problem for those of us trying to rent, but also from the Fed's perspective and thinking about meeting their 2% inflation goal. But for right now, the shelter numbers are, I'd say, normal. What's more worrying is things like, core services ex housing, which for right now are slowing, but there's some quirks in the CPI. Medical care is maybe dragging that down a bit. So really the underlying wage pressures is what we're trying to get at. And those just aren't slowing enough, I think, for the Fed to take comfort in where it's at on inflation.